Hey everyone, welcome to the Invest With Nikkei podcast, where we talk all about real estate, wealth building, and how to build your financial independence so you can retire early. I am super excited today. I have my friend CJ Tarantino, the real estate CPA, on with us to give you guys so many goods today. Say hello, CJ.
Hey everyone, Nikki, thanks so much for having me. So excited to chat with you and share some valuable information that I've learned from my clients.
Yeah, we are so excited to have you, my clients, and just our audience loves to learn all about, how they can build wealth and really have good strategies when it comes to their taxes. A lot of our clients and listeners are earning really good money. They've worked really hard their lives. They are busy professionals, business owners, doctors, attorneys, and they're making a lot of money, but they're also giving a lot of it over to the government when it comes to time to pay taxes. And they want to know, like, okay, I'm working hard, how do I keep more of this money, right? And we have some strategies to go over with you guys today. We're going to be talking about why short-term rentals are powerful and the STR loophole, which is actually not a loophole, so you're just going to break that down for us, how the tax strategy plays into that, what you really need to consider before jumping in, how to structure it correctly, and why you don't need to be a real estate professional to qualify for this strategy. And we're going to dive a little bit into, like, can you use management or co-hosts or assistants to do this, or do you have to do it all on your own? And then really talking about the timeline, like how quickly do you need to make this happen so that it can all work out the right way so you get the most benefits. So TJ, I want to open it up. Tell me, why are short-term rentals different when it comes to the tax strategies?
Yeah, so great question and really good place to start. So short-term rentals are technically real estate, but they fall under a different rule set than traditional forms of real estate. And so a lot of times you'll find as you start going into the real estate investing and tax benefits, you start to run into some limitations that get people disappointed. The short-term rental strategy is a way to kind of go around that and achieve the same result. So to put it simply, short-term rentals fall under a different rule set. They're more of an active business than they are traditional real estate.
And talk to me, like, so we're operating short-term rentals as businesses, right? Not just as rentals. And when we're doing that, why is that different to the IRS, and how does that really benefit the client?
Right. So the key indicator is that if your property is rented out on average 7 days or less, the IRS starts to see that more of an active business than it does traditional real estate where you have a long-term tenant in there. And really, why is that relevant? It opens up the ability to tap into some of the tax benefits that we'll kind of dive into. But that's really the key there is the 7 days on average, 7 days or less on average. They start to see it more as an active business. You have guests coming in and out. There's more operational components to that than just, hey, set it and forget it, long-term tenant in the property.
That's great. Yeah, and I think one of the things we're going to talk about a little bit today as well is even though it's a very active business, there is a lot of ways now with tech and AI that you can make it a business where it's really, you don't have to do a lot because of the automations and the tech that's available now. You can, almost be in a place where it's very little time invested because there's a lot of tech and automations that you can implement. Do you see your clients doing
Yeah, I think
that
we see.
mostly?
Yeah, and I think you see just AI, the quick changing nature of it across the board in every industry, right? Even like our personal use of AI and what we're using to, power how we serve our clients. I think that's just happening across the board. And, the way I see it for, STR hosts and investors is that it's just making the ability to run a short-term rental even more easy and creating less of a barrier to entry for you to be able to do it. A lot of the clients that we work with are high income earners, whether it be in the tech industry, medical professionals. So high income earners don't have a lot of time and they're looking, how can I reduce my tax burden in a realistic way that's legitimate. And that's where you kind of fall into short-term rentals being a great use case for that. And that AI component is just giving you the ability to save on some of the time elements that you may not have.
Yeah, that's great. So, can you break down what exactly the short term rental loophole is? And I know it's not a loophole, so I would love to know more about your thoughts on that.
Yeah. So it's in terms of like how it's talked about now. It's kind of come up with this phrase of a loophole, and the reason that kind of is that way is it's kind of real estate. It's a property that you purchase, but it falls under like an active business. When the tax code was written as it's currently written, it, they didn't foresee the prevalence of like Airbnb and VRBO, short-term rentals. So it kind of falls under rule sets of like a hotel, traditionally would. So that's kind of like how the loophole exists. And then really what this is, right, is you buy a property and you rent it out 7 days or less on average. That allows you to have it be treated as a short-term rental for tax purposes. Then you need to actively manage that property, right? And we can go into the ins and outs. I know a lot of people look at property managers, co-hosts, and all those different avenues, but you do need to manage in a certain capacity. We'll dive more into what that looks like actually, but so you manage the property, and then you're going to do what's called a cost segregation study on that property. And so that confuses a lot of people. We'll kind of keep it simple and go through an example there. But you're going to do a cost segregation study on the property, and that creates this depreciation event. Essentially, what you're doing is you're front loading depreciation into the first year, as opposed to waiting to capture that depreciation over a period of time. Why that's nice is that you are say you make 500,000. You go buy a short-term rental, and now you're creating this depreciation event that can essentially be written off against your income. So that's kind of, you buy the property, run it as a short-term rental, rent it out 7 days or less on average. Then you're going to do the cost segregation study to create the depreciation, and that's kind of it in a nutshell. But there's nuances we'll kind of go through to unpack.
So, can a high income earner legally pay zero tax in a year using this strategy?
So there are some nuances that you need to look at for your specific situation, and a lot of times you can significantly reduce your tax liability. So to kind of give you an example, common theme we'll see with like our clients, right? Anywhere from 300K or more income, 500K, 700K. You buy a short-term rental, say $500,000 property, right? Let's just use that for a simple example. When you do that, a portion is going to be allocated to land, and then a portion is going to be allocated to the building. Let's just say 80-20 split. That's kind of a common example. You do want to be mindful though of where you buy. In some areas, the land value can be higher, right? So certain areas like in California, maybe
Or
even
like
in Florida,
beachfront?
beachfront,
Yeah,
right? They're going to value that
right.
land higher. And why that's relevant is it's going to decrease your depreciation benefit. The land value cannot be depreciated. So let's, in our example, 80-20 split. So 500K property, 400,000 is allocated to depreciable property. When you do a cost segregation study, you'll find that that creates about a 25% benefit. So on that 400,000, 100,000 would essentially be able to be written off in year one. So that's $500,000 property, $100,000 benefit right there.
That's great. And an average person who's making, let's say, $500,000 a year, how much taxes are they typically paying in, just in general?
Yeah, so I guess the best way you can look at it, right, is okay, I have that $100,000 deduction in my example. What does that mean in terms of like actual dollar tax saving? So let's say you're in the 37% tax bracket, the highest tax bracket. That's essentially $37,000 saved in my example. Now, you do need, this is one piece of your overall situation, right? So if you have income sources elsewhere, you take out a retirement distribution to help fund the property, all those nuances have to be factored in. And that's why I always come back to the best thing you can do is just work with someone that can really dive into your situation, put all the pieces into place, and just make sure, hey, how does this fit into my overall strategy?
Right. Yeah, I definitely would recommend, someone meeting with you. Like, let's say that they haven't done this strategy before and it's now May 21st of 2026, and you kind of generally have an idea of the type of income that you're going to make in a year. Even if you're commission based, you can kind of look at your prior years and predict, even if you're scaling each year, you can kind of know, hey, this is what I'm going to be earning in a year, and you can have that conversation and you can talk about, well, I have this many dependents, and I'm also receiving child support, or I'm receiving alimony. Or you can kind of have that conversation with your CPA of like what your personal situation is, and did you sell any assets that year, and basically just like they need to have that time with you to really get that strategy before it, like right now is really critical time, I would say, if they haven't done the strategy for this year. When you say like they just got through tax season, now it's like we need to really make the strategy for 2026 so you have time to execute.
Yeah, I think that's well said. And I think just what would be helpful is a shift of mindset, right? A lot of people are still working with, hey, I work with an accountant. They're my tax preparer. I bring my documents in February, March, even April. They get my tax return done, and then I kind of just rely on that, and hopefully I got the best bang for my buck there. This is a little bit of a mindset set shift of, hey, I'm going to work with someone proactively to help reduce my tax liability. So how we're able to add a lot of value to our clients is we run what's called a projection. And basically we map out what you expect for this year. And then we can run scenarios based on that, right? So a lot of clients, their income fluctuates more than, others, right? And so we kind of map out, what does it look like if you were to, here's what your tax liability is expected to be if you don't do anything. And then now we can kind of back into, this is kind of the size property you would need to buy to help really, offset your tax liability. So kind of do planning that way. And then, we meet with our clients, throughout the year. So we're able to revisit that projection. What's changed? What has your goals changed? Has something happened? And really, it's just keeping our eye on the ball of how, when we do your tax return next year, we already kind of know what the result's going to be. So more of proactive thinking than retroactive of, hey, I dropped my documents off and hopefully everything goes well. Hopefully I get a good result.
Yeah. But they should only do that if they want to build true wealth, right?
Yeah. If you want to build true wealth, yes, you should do that.
Yeah. I always kind of reference, someone taught me one time when I was really starting to just learn about building wealth. And this was like about a decade ago that I really started diving into all of this because I was tired of being broke no matter how hard I worked. And I remember I hired a financial coach, and she told me something. She's like, Nikki, if you're always looking in the past and in the rear view mirror, she related it to a car, you're always looking behind you, you're never going to be able to get ahead and see what's coming forward and like look through your windshield at the future, right? If you're always looking behind and you're looking at that rear view mirror. And that was just such a like cool metaphor for me, because I was like, gosh, yeah, like I am always like kind of feeling like I'm behind or looking at the past. And like, I think what you said there, like that mindset shift, I really love that. That is critical to this game, right?
Yeah. Yeah. I couldn't agree more. And earlier in my career, setting my mindset shift as well has been incredibly helpful and has allowed me to kind of help my clients with that as well.
Definitely. So let's tackle one more piece on our about the what is the short terminal loophole before we move on to the next section. Is talk to me about the role of material participation.
Yeah, so that's really, really, really key when it comes to this, right? A lot of people where they maybe they see the marketing or the the catchy headlines online is like, I just buy a short term rental and now I have a tax write off, right? That's where you're going to run into problems. Um, Material participation is the key metric you really need to hit, and you need to track it proactively. It's your hours spent involved with the property. There are a number of tests in which you could, you could meet this. I'm not going to bore you with listing them out. Most commonly, people will meet the 100 hours or more than anyone else involved. Don't forget that second piece, more than anyone else involved. People seem to overlook that sometimes. So you need to have at least 100 hours in the year, and you need to spend more time than anyone else involved. So handyman, cleaners, potentially co-host, things like that. You need to outperform anyone else. The IRS wants to see that this is you're involved operationally, and you are key to the operations of this business now. And so a lot of times we get the questions of what counts, what doesn't. It's hard to really say, give you everything that counts and doesn't. Most of my clients will run those kinds of things if it's uncertain by me. But the way to think about it is any operational activity generally counts. So uh, talking to tenants, guests, if you are, dynamic pricing, all those different things, right? Updating the listing, anything that's key to the operations.
Yeah.
Now, investor type activities are not necessarily going to count, right? Like I just kind of look at the overall economics of it. I'm looking at different markets to see what makes sense. That's more of investor activities. That generally doesn't count. It's active involvement with your property.
And does that start like when you go under contract on the property, or is it only once you close and you own that property?
That's a really good question. So, what I always suggest is track your time, um, regardless, because you can capture some of the hours. If it's a property that you spend time on and then you close on, you generally can capture those hours spent on the front end. If it's one that you don't close on, then you likely wouldn't be able to use those hours. But I think it's just track your hours, get in the habit of it, and basically just kind of build up this case. And what that looks like, people do it differently. Clients that work with us, we usually give a template, an Excel template that kind of models out how you should track this. And really what this is, it's not something that you necessarily attach to your return or provide upfront. It's more so just building out your documentation. If you ever got audited, they're going to want to see this time log 100%. And they're going to look at it and say, show me how you spent the time and you took this loss on your return. Show me the documentation around that. So dates, the time spent on a specific activity, description of that activity needs to be clearly documented, and it works best if you do this proactively, not retroactively. It's going to be really hard to do this and just like, hey, at the end of the year, I'm going to go back and put this together. And it could be scrutinized. And if one thing looks unreasonable, it can throw off your whole, it can add scrutiny to the schedule as a whole.
That's great. And I'm sure that's something that you review with your clients yearly and make sure that they're tracking accordingly, right?
Yeah. So the clients that do planning with us, that's definitely a key piece of just making sure that that looks good, that you're on top of it. And, because it really is the kind of the baseline for making sure that you can legitimately take this strategy.
Absolutely. Absolutely. And talk about why would spouses matter in this strategy?
So, in with regards to this strategy, right? And a spouse would be helpful in helping you meet the hours. Um, I think this would bring a good point because a lot of times you might get people that ask you, "Hey, do I need to be a real estate professional?" This is the strategy to not be a real estate professional. Real estate professional really applies to traditional forms of real estate, and that's where you need to meet 750 hours for the year and more time in real estate activities than anything else that you do. So if you're a W-2, medical professional, tech executive, you're likely not going to meet that time requirement. The short-term rental is an approach to kind of get you to the same place without meeting those tests. Um, Typically, you'll see where a spouse is helpful in that regard, right? If my spouse can be a real estate professional, then I kind of, and we file jointly, we share in the benefits together. So that's the most common use case for, hey, can my spouse spend the time in real estate? Versus, and I spend my time in my career, my profession, my business.
That's wonderful. That would be really great for a couple, building wealth for the family to be able to leverage that. With
Yeah, and a
me,
lot
me
of
being
our
a
planning, yeah, and a lot of our planning will kind of help clients understand that and kind of see, hey, what would be the benefit of my spouse maybe focusing on real estate full time, given like what they're doing now, and kind of, hey, does it make sense for you, given like what's the tax benefit that you can expect to receive doing that versus does it make sense to just for you both to just continue on in your main role? So we'll help map that out. And I from our perspective, it's always it has to make sense for you economically, lifestyle wise, and then tax benefits are kind of the icing on the cake, or they're a secondary lens. That's the lens we think through. But really, it's got to make sense for your goals, the economics, and those various components first.
Yeah. Yeah, it's cool. I remember when I first started learning about this, and me being a Florida realtor having a license, I was like, oh, well, I already qualify for real estate professional status, so I don't necessarily have to qualify with the hours, right? Because I mean, this is my full time career. My full time career is helping my clients buy and sell real estate, and I have my own portfolio. We now have 5 active short term rentals, and so that is something I just wanted to, I'm not saying that that's like an easy out, but if you are already in real estate, it's, really cool because you have another kind of opportunity here by being licensed is you can also take advantage of this because you are already a real estate professional, and it's like you are doing real estate full time, right?
Yep, yep. And I think what's probably most helpful is just working with your accountant or working with an accountant that can just look at your situation as a whole and kind of put those pieces in place and kind of understand how you're spending the time and what tax strategies align with your specific use case.
Great. That's awesome. All right. So now we really understand, why the short-term rentals are different, what the short-term rental loophole is, why we need to make sure that we get those hours in and why that's important. Let's dive a little bit more into the cost segregation and the bonus depreciation. So, what actually is a cost seg? Like a cost segregation. People hear that term, they don't know what it is. What is that?
Yeah, so cost segregation is a study that's done by a cost seg firm. So we work with a number of them that do really good work that we refer our clients to. But you're going to work with a cost seg firm that will go and evaluate your property, and what they're looking for is to break the property down into certain components. So let's say if you don't do a cost segregation study and you acquire real estate, and it's gonna be allocated to land and building, and that building portion is going to be captured over a long period of time. So with short-term rentals, it's technically 39 years is how long it's going to take you to capture that depreciation benefit. What the cost seg firm will do will evaluate and break it down into different components. What's not necessarily structural? What is land improvement? What is personal property? And why that's relevant is it opens the door for bonus depreciation. You can take bonus depreciation on those other assets that they break out. And so bonus depreciation is just the term to mean I can write it off in that year. So instead of waiting, I can take 100% benefit now, and that's why the headline last year was so exciting, where they made bonus depreciation 100%. Before that, it was set to decline, and like in 2024, it was 60% was actually the bonus depreciation benefit. So it's really made this really powerful strategy. But yeah, so the cost segregation study, they're just breaking out that property a little bit more. And what you generally see is about 25% of that building allocation is going to be reallocated to assets that you can take bonus depreciation on. So like in my example, 500K property, 400 to building, they're gonna basically reallocate 400,000 to of they're gonna reallocate about 100,000 of the 400,000 to bonus depreciation, $100,000 benefit.
Right. So all those things that are like not the roof and the structure and the like all the actual pieces of the structure, right? 100,000 in your example, 100K of that is going to be like the furnishings and the appliances and like that kind of stuff, right?
Yeah, yeah, and they give you this nice detailed report. Every company is a little bit different, but why that's also helpful is it breaks out, like, even if they'll be able to assign a value to the roof. Why that's helpful as
Mm-hmm.
well is that, say, 5 years down the road, you replace that roof, you can now write off the cost that was associated with the old roof. So it also gives you the ability to have a breakout of your property that, as things change, it also could provide a benefit for you.
Oh, I didn't know that. That's really cool.
Yeah,
So,
that's a nuance that not everyone is aware of. It gets kind of technical, but it's essentially,
yeah.
it's called a partial asset disposition, and you really need the cost seg to be able to give you the value. Okay, what's the value of the roof
Yeah.
alone, right? So that when you replace the roof, now say you spend 30,000 on a new roof, you're going to add that to your depreciation schedule, but you'll be able to write off whatever was there that you haven't taken depreciation on at that time. So another great benefit.
Yeah, that's awesome. But that you got to have that cost seg as like the foundation for the property
It
to
gives you the
work from.
documentation behind,
Right.
you can't just say, oh yeah, I think it's worth this. It's a report that clearly says a professionals assessed this property and they gave the value to it.
Yeah. Let's talk a little bit about like new build properties versus value add versus condos. Like, can you talk about like what makes sense, what doesn't, what are the pros and cons of the different property types?
Yeah, so I think, it really matters what property, what price point, what income range you're in terms of the tax lens of things, right? Um, Condos can be nice in the sense of the land value in a lot of cases could be low and make the depreciation benefit higher. Um, New build, um, I think you just want to be mindful of timing, right? And I know that was one thing that we wanted to touch on, is that to use this, the property needs to be ready to be rented out. And you'll want to have at least a couple guest stays before the end of the year to really substantiate the strategy. So if you're doing a new build, just be mindful of the timing, right? When is this going to be completed? If I'm expecting and I'm using this as part of my tax plan for, let's say, 2026, that needs to be ready to go before the end of the year. And essentially, you're going to want to have a couple guest stays showing some income from the property as well. So I think timing is a big component of it. And then just looking at what is the purchase price of my property? What can I expect what can I expect the benefit to be given the income range that I'm in?
That's great. So, like, let's say I buy a new build versus like an older home that I'm doing renovations on. What's the difference in benefits in those, and how does that work?
Yeah, so if you're doing a new build, you're kind of going to go the same approach, right? You're going to want to look at what's the cost segregation study benefit going to be. So it really is, it's kind of the same approach. It's just more so, I think, of what, you know, what are the economics going to be of the property, right? I think it's more, what property are you buying given your investment criteria versus like the potential tax benefit. Um, you do a new build once it's constructed. You're going to do a cost segregation study, kind of see what the benefit would be there. Same thing, you buy an existing property, you can do a cost seg just the same. I think it's more so just timing, and then also just what's the best, what market are you buying in, and what buying the
Mhm.
right deal essentially.
Okay. But I'm wondering, like, when I buy an older property and I renovate, do I get to take all that value of all the money that I put into it, all the renovations?
Yeah, so you'll be able to capture those renovations, and then it's just a matter of, are you are you buying the property, doing the renovation, and then should you wait to do the cost seg so it can capture all of that and give you the best benefit there? Or if you're buying a property, you rent it out and then do the renovations, it's just captured a little bit differently. But yeah, when you renovate a property and you put cost into it, you're definitely going to be able to capture that. It's just a matter of what that looks like specifically.
Okay.
Different type of work gets reported differently, comes with different benefits. And that's where we come in, is just analyzing that and just making sure, how do we optimize that? What's the best way? What's the correct way to kind of get that on your return?
That's great. Yeah, I mean, I have usually a lot of clients that come to us in like October, November, and they are scrambling to buy a short-term rental before the end of the year, and then get it furnished and get it launched and listed, and then start taking guest bookings. And they're trying to do all that before December 31st, because I've heard technically you need to have the 2 stays under 7 days before the end of the year to qualify. And so there's this huge rush at the end of the year to do that. And I think that that's only possible if you are truly buying like a turnkey property that doesn't need any work. Because if you're buying something that needs work, like an older home, let's say it needs renovations, that can really delay things and you might not have it launched. I do have a client recently who was supposed to be launched the end of last year, and she's not even done yet. It's almost June. And so she's 6 months behind on her project, and she didn't get to take the tax benefits for last year that she thought she was going to, because she had challenges with her contractor. So, those types of things are all things you need to think about when you're looking at the timing. And it's May 21st. If you're planning on launching a short term rental this year, now is the time to really get serious, find your team, start looking for a property, start making offers, start getting something under contract so you can be planning your design, planning your setup, and then getting it closed and getting all of that executed so you can get your stays before the end of the year. I think that's super important for you guys.
Yeah, I couldn't agree more. I think, delays happen, and just the more you can be proactive and just get ahead of the timing. If this is something that you're considering for 2026, it's definitely something that you want to start evaluating now. And then you also don't want to put yourself in a position where you're chasing tax benefits and maybe you're not buying the best deal. If you're starting to look now, it gives you time to evaluate and make sure you're buying the right property. And I'm sure you could probably speak to this as well, as in just what I'm seeing and going to, with my clients, going to different conferences and things like that, is really with short-term rentals now, the key is really the amenities, the design. You really have to crush it in that regard. It's not as easy as it was just buy a property and I will win. You really have to nail those elements, right? So you do want to make sure you're taking the time to nail that as part of your property as well.
Yeah, absolutely. Absolutely. You got to definitely have all the things, the pools, the hot tubs, the outdoor kitchen, the game room, the movie theater. I mean, you got to really make sure that you're bringing a top tier property, to market so that you can not only get the tax benefits, but also cash flow and, have a property that is going to perform well. So,
Yeah, I mean, and that just to come full circle on the wealth building, right? That's I mean, this is a great use case for that, right? You have this property that's going to cash flow ideally more than other avenues of real estate, because you're adding those design and amenities, and you have the frequent guest stays, and then you also have a appreciating asset. You get to take tax benefits, so it checks so many boxes in terms of the overall wealth building strategy.
absolutely. Yeah. So let's talk about what should high income earners be considering before they're buying? Like, what are they're like, hey, I need to do something, but I don't really know where to start. What should they be considering before they're really buying the property?
I think just really getting educated on, you know, is this something that we can implement? You know, does this make sense practically to implement? Right? Do we have the capacity to to take on a project like this? Start to map out those tax benefits. You work with someone like us, that can help you kind of quantify what that would look like and help you understand. The potential tax benefits. But I think it's really getting educated on, there's a lot with short-term rentals that you need to be educated on, right? The different markets, the restrictions and regulations in different markets. So I think the education piece and that's why you want to start soon, is just making sure you understand those components.
Yeah. Yeah, and then there's the the financing. How are you going to finance it? How much cash do you have to really acquire the property and design the property? How are you going to manage the day-to-day operations? Insurance, the right team, having like your CPA, your lender, your realtor, the cost segregation company, an attorney, maybe you're setting up asset protection. Are you going to buy this in a business? Or are you going to buy it in your personal name? There's a lot to consider there. And that's why you come to us. That's why you're listening to this, to learn. And that's what we're here to do, is to help you. But there is definitely a lot of things that you want to start learning before you just go and buy the property, pull the trigger, right? Wonderful. All right. This is really good stuff so far, CJ. Thank you so much. So let's talk about the future of short-term rental investing and tax strategy. Do you think that this is like here to stay for high income earners to be able to use this strategy?
I really do. And the reason that I do is that, like I had mentioned last year, the tax law change of 100% bonus depreciation. The nice thing about the way the tax law is written now is that is the case indefinitely. It would take a change in the tax law to change that. Where previously that bonus depreciation was enacted, but it had a declining component to it, meaning it was 100%, then it was 80%, and 20% decline each year. It's 100% indefinitely. So I think from a tax lens, I think this is here to stay. I think it's a great play. I think it's if you're a high income earner and you or your spouse are not able to meet real estate professional, this is a great use case to get in real estate, achieve the same kind of tax benefit, have a lower hour requirement to get there, and experience great tax benefit.
Yeah, absolutely. A lot of my clients are, they are earning, 300, 400, 500 and plus every year. And their goal is to actually buy one property per year. And let's say that they have like 10 more years to retirement. And then they're like, I'm just going to have 10 properties that net me 50 to 100K per year. And then at 10 years, when I retire, I'm literally just going to live off of my short-term rental properties, and somebody else will be paying the mortgage, and I'll be making 500 to a million a year in my revenue from, I'm not going to say passive. Some people say passive. Short-term rentals are not passive. That's what we're
It's
trying to tell you guys.
Misleading,
right?
yeah.
Right. But their goal is like, yeah, the next 10 years, I'm just going to buy one property a year and then retire and have that income. And then they're going to get to take advantage of those tax benefits every year from that each property that they buy. And, that's even what I'm doing. I mean, I am literally doing that same exact thing. I'm trying to buy as many profitable, smart investments now while I'm making my highest income through the peak of my career, so that when I go and retire, I've got something there that's going to supplement my lifestyle, right? And I'm personally not investing as much into like stocks and things like that. I put some into those things, but I'm really putting a lot of my investment into these short-term rentals so that I can have that cash flow and the tax benefits and the appreciation and the principal pay down and the ability to go use the property, the lifestyle asset part of it. That is the strategy that I really love. And it's not for everyone. As we've talked about, it's definitely an active investment, and it takes skill and it takes work, but it's definitely pretty strategic for those people who are interested in it. And I think, CJ, you were going to offer something.
Yeah. So a couple things there. Just wanted to piggyback off of. So in your example of the goal of acquiring one per year and kind of building that out as a revenue stream, what's also really nice about real estate is that there's a lot of tax advantages built in the tax code for real estate to incentivize real estate investing. So there's a lot of avenues that you can take of like even acquiring some properties and then, hey, maybe I want to sell and level up the level of property I have. So there's a thing called a 1031 exchange where essentially you sell a property and you defer the taxes, and basically you buy a property, sell it, and roll it into a bigger deal. So there's a lot of different cool, creative things with real estate that can be captured on the exit of real estate. So I think that's a really cool thing to mention. And then also, you had mentioned lifestyle asset. That's one thing you do want to be careful of. If you are using this as part of your tax strategy, especially in the year in which you're doing like the cost seg and depreciation, is limiting your personal use. You can evaluate that down the road of to what extent, but you just do want to be careful of how much you use it personally.
That's right. Yeah, definitely. That's something that they need to discuss, with you, their CPA. And
Yep. You definitely want to
whenever
discuss
I
and
go
map that
to,
out.
yeah, it's something I want to just get some clarification on is when I go to my properties, I am there and I'm working. I'm not there like enjoying the property. Of course, I'm enjoying it a little bit, but like I'm meeting with my contractors. I'm looking at future projects. I'm doing little handyman things, that I'm doing inventory of my linens and my supplies, and I'm doing quality checks on the cleaners. So like is there a way to differentiate that as like I'm personally vacationing at my property versus I'm actually here working?
Yeah, that's a really good question and something we get a lot. And yeah, so when you are there working at your property, just critical to really document that. And then you potentially would not have that count as a personal use day. It's a little bit of a gray area, but what you see from like court cases, if it's like you spent like 4 to 6 hours, a good amount of your day was, geared towards operations in your property, you're generally fine. Not, hey, that wasn't a personal use day. Yeah, I was here, I stayed there, but I'm handling things that are key to operations of this property. And I would argue that you wouldn't include that as a personal day. So really, really good question.
Makes sense. Awesome. And I just want to touch on, with AI and automations, the future of short term rentals is really bright because, with my 5 properties, it's very limited energy and time that I have to put into them every week because of how easy softwares and systems have made things. When a booking comes in, all the messages are automated to the guest, all the check-in instructions are automated, the cleaning tickets are automated, the cleaner gets notified immediately that there's a booking and that they need to go and clean. All of that stuff is just pretty much automated, and it makes running the properties very simple. Now, I'm not trying to say that this is passive or that it's easy. There is so much to learn, and the industry is constantly changing, and you do need to stay abreast of what's happening and understand that trends change in hospitality, fads change in hospitality. Right now, wellness is blowing up, right? And um, the tech is always changing, but I do think that it's a very easy barrier of entry for anyone that wants to just start this and learn it. And you can absolutely, I have clients who are surgeons who have, one of my clients, a surgeon, and she has 40 properties. So, and she runs those properties, and it is so possible for you if this is the way that you want to go. And we can definitely help you learn all of that good stuff. So, all right, CJ, we're going to go into some rapid fire questions. Okay. So we're going to
Let's
have
do
some
it.
fun. All right. Biggest mistakes high earning individuals make.
Paying too much in taxes. And then with regards to short-term rentals specifically, is I just buy a short-term rental and now I have a tax benefit. Like we unpacked throughout here is that you actually, there's some documentation and key things you need to have in place.
Nice. Next, cash flow or appreciation?
Both actually. I think you buy the deal that gives you the cash flow and that, creates a good benefit now. But then also you'll have this appreciating asset, that you get to, help build your wealth. And then the third piece is the depreciation benefit, for tax purposes. So, triple threat.
Yup. Triple threat. Yep, absolutely. All right. Biggest IRS misconception.
Biggest IRS misconception is, let's see. So I think what I had said before is that I can just do these tax strategies, whether it's short-term rental or others, and not have my documentation in place. If you were to get audited, they're going to want to see the documentation. So you just don't take things in without really having that documentation in place.
Yes, awesome. Well, that was so much fun. I definitely appreciate your time. You've brought a wealth of knowledge. Can you share with everyone where to find you, how to connect, and how to work with you?
Yeah, so on social media, CJ the CPA. So we post content on there, some things that we're working on with our clients. So definitely follow for more content there. And then if you're interested in potentially seeing how we can help, we start with a free discovery call just to unpack your situation, see what you have going on, see if we're a good fit to help. And so I'll provide the link here that we can include if you're interested in that.
Wonderful. Yeah, we will have all of that in the show notes for you guys. So you guys can go follow him on Instagram. I definitely would, just have the conversation, book some time, have a conversation. And, when it relates to you and it's directly your situation and you can talk through things and answer questions that you have that are burning inside of you, it's so valuable. And, everyone's time is extremely important. And CJ is offering that as a free consult. I would absolutely take advantage of that. And, you'll probably walk away from that meeting with a lot of clarity and probably some relief and peace as well if you're in a position where you're just really stressed about this. And he can probably really make it pretty simple, as simple as being a CPA and taxes can be, right? Wonderful. Well, thank you, CJ, for your time. This was an awesome episode, and thank you guys for following along. We'll see you next show on the Invest with Nikkei podcast. All right.